You'd have to be a real fool to believe that I would be foolish enough to buy Bitcoin. Now, yeah, Bitcoin had a great quarter, and I'm going to get to that, but enjoy it while you can. You'd have to be a real fool to believe that I would be foolish enough to buy Bitcoin. Now, yeah, Bitcoin had a great quarter, and I'm going to get to that, but enjoy it while you can, because it's not going to be repeated. Because the real fools this April Fool Day were the people who were buying all these tech stocks during the first quarter, including cryptocurrency, Bitcoin, all this risk stuff got bid up in the first quarter of 2023. You know, a lot of people got caught off guard by the strength that we had in risk assets in the first quarter, right? I mean, the NASDAQ, in fact, the NASDAQ had its best quarter since the second quarter of 2020. It was up 17%, I believe, on the quarter. And the reason that the NASDAQ did so well back in the second quarter of 2020, that's when the Fed, went back to QE. That's when they slashed interest rates back to zero because of COVID. Now, the market sold off early on when COVID first got started. But once the Fed went to zero and launched QE, infinity for QE4, that caused the NASDAQ to snap back very sharply. And so you have to go back then to find a quarter where the NASDAQ was as strong as it was in the first quarter of this year. Now, of course, the NASDAQ went way down. It was down about 30% for 2022. So big move down. It's not that crazy that we had a snapback. Plus, I think a lot of people were probably short a lot of these tech stocks going into the year. Certainly people who were short these stocks made a lot of money on those shorts in 2022. And so a lot of them were probably still there in 2023. And the expectation, of course, was that the Fed would keep hiking rates. And in fact, it did. We had 75 basis points of rate hikes during the first quarter of 2023. So that is what the markets had expected. And all of that, of course, had been bad for tech stocks. But the reason we got the sharp turnaround is because of the economic events, and most particularly the onset of the 2023 financial crisis that really changed the mindset. And I think even prior to the onset of this financial crisis, you were starting to see a bid in the tech stocks based on the idea that the tightening cycle was coming to an end. Yes, maybe the Fed was going to ratchet up rates a couple more times, but it didn't matter because the lion's share of the work had been done. And we were now on the cusp of another easing cycle. The Fed was soon going to be cutting rates. And of course, quantitative tightening would eventually give way to another round of quantitative easing. And so investors wanted to get ahead of that. Remember, the markets look forward. So they're looking beyond the last few rate hikes to the first rate cuts. And not just the first rate cuts, but the many, many rate cuts that are likely to follow, as well as the return to quantitative easing. And I think that is what is responsible for the big rise in the NASDAQ. And if you look at what happened with the Dow, for example, the Dow was barely positive. In fact, it may have been negative up until the last day of the quarter because the Dow was up 400 points on Friday. And the Dow only gained 0.4% for the entire quarter. So I think all of that gain was attributable to Friday's rise. So, but for that rise, the Dow might have had a negative quarter. But the S&P 500 was up about 7%. And what powered the S&P was the tech stocks that are large components of the S&P. Certainly other sectors of the S&P, like the financials, did extremely bad, right? The financials got clobbered, especially at the latter part of the quarter. But the tech stocks were strong enough that it outdid the damage done by the financials. But if you look at, let's say, the Russell 2000, which doesn't have nearly as much tech as the S&P or the NASDAQ, obviously, that index was only up 2.3%. So not nearly as big a bounce. Now, I didn't participate as an investor. I didn't own much of these tech stocks. Actually, I did own some of the Asian stocks. I had some tech stocks in Asia. Some of them are in our funds. So we caught a bit of the tech rally, but we're way underweight tech in general. But where we were able to participate was in the gold stocks, because the gold stocks had a decent quarter, not a spectacular quarter, but they had a decent quarter. The GDX was up 13% on the quarter, and the juniors actually didn't even do as well. They were up about 10% on the quarter. Now, for those of you who are shareholders of the Euro Pacific Gold Fund, we actually did a little bit better during the quarter than both of those index. The Euro Pacific Gold Fund was up 14.2% during the first quarter. So not nearly as much as the NASDAQ, although actually not that far behind, 17% versus 14%. So almost as good as the NASDAQ, but a lot better than the S&P, and certainly even more better than the Russell 2000 or the Dow. And what I think should be going on right now is more people who are buying these tech stocks should actually be buying gold stocks instead, because I think the gold stocks are the new tech stocks for this new easing cycle. The people who are buying tech stocks all quarter were correct in their judgment that we were coming to the end of the tightening cycle, because we were. And they were correct to anticipate that there would be an easing, which there already has been. I mean, the Fed has already acknowledged that it's probably not going to hike much, if at all. And whether they want to admit it or not, they're back to quantitative easing. Although this week on Thursday, when they reported the balance sheet, it actually shrank again by about 25 billion. So we didn't have a third week in a row of an expansion. There was a little bit of a contraction, but I think that is the exception, not the rule. I think going forward, we're going to see the balance sheet continue to expand. Every once in a while, there may be a weekly contraction, but the direction now for the balance sheet is up. But I think investors are wrong in thinking that this easing cycle is going to be good for tech stocks. I think they've got it wrong. The last easing cycle was great for tech stocks, but I don't think that we're going to repeat that. I think this time around, it's going to be gold stocks. And in fact, if you go back to the 2000 bubble that popped, and NASDAQ was down 80%, mostly because of those tech stocks, the tech stocks rebounded from 2002 to 2008 when we had the financial crisis. But the gold stocks did much better during that easing cycle, because the Fed moved rates down to 1% and then kept them there for a while and then gradually normalized. But during that entire cycle, the gold stocks actually did much better than the tech stocks. So I think the same thing is going to happen this time. It's not going to be the people in tech stocks are going to make money again like they did from 2009-ish all the way through 2021 or whenever that bubble finally peaked. It's not going to be the same, nor is it going to be the crazy days of the COVID lockdowns where all these tech stocks, went ballistic. Because what I think investors don't get is that inflation is the wild card, because it's not going back down. The last easing cycle was good for tech stocks because inflation was below 2%, at least the inflation that anybody admitted to, right? The Fed was below 2%. And so in that environment, it was able to get away with quantitative easing, low interest rates, and the dollar was strong during that time period. And so I think this favored the tech stocks. But I don't think this easing cycle is going to look anything like that, because what I think is going to happen this time is inflation is already well above 2%. And, we got some more inflation data on Friday. We got the personal consumption expenditure index, and contained within that number, there was a better than expected reading on inflation, but just barely. The core PCE, which is the least accurate, and therefore the Fed's favorite way to measure inflation because it understates it the most. It was supposed to go up by 0.4 on the month, and it went up by 0.3. I mean, big deal, because 0.3 annualized is still way above the Fed's 2% level. I think it's right now, if it annualizes out, I think year over year, we're at 4.6% rise in the core PCE. You know, the core, right, that strips out food and energy, right, which was even higher. But even if you strip that stuff out and you go down to the core, you're still at 4.6% year over year. Yes, that was slightly better than the 4.7% that they were looking for, but it's nowhere near the 2%. But what's more significant about that is that that's where the year over year core PCE is when the Fed has stopped the inflation fight. It is no longer hiking rates, but more importantly than the rate hikes, is it's back to quantitative easing. The Fed is creating inflation. The Fed is printing money all over again, and that just fuels the inflation fire. So I think we're kind of at trough inflation now. Maybe it gets a little bit lower, but we're not going to get anywhere near 2, and then we're just going to pick up momentum.